Well, good morning, everybody. Let's go ahead and get started. It is Friday, December the 8th, and welcome to Newton Associates CPA 2017 Year-End Tax Planning Strategies. For those of you that don't know Ed, he is the senior partner at Newton Associates CPA. Newton Associates CPA is an established Charlotte, North Carolina CPA firm that provides tax, compliance, and planning services to individuals and small to medium-sized businesses located in the U.S. and various foreign countries. Ed has been a CPA for over 40 years and brings a wide variety of experiences and expertise to the firm. Ed, welcome to the call.
Well, thank you, Jeff, and hello, everyone. Although there's only a short time remaining before the end of the year, I did want to give you some ideas that you may be able to use to reduce your 2017 taxes. And I know some of you certainly have, and I do too, have questions as to the new tax law. We're not going to be covering that today, and the biggest reason that I am not going to cover it today is because we really don't know what it's going to be. It does look like something's going to get on the president's desk, and I'm sure he'll sign whatever it is. But and I'll make a couple of comments as we go along about what we might see coming up next year. But we will have, as soon as the new tax law is passed and I have an opportunity to go through it and our staff does, we will be having another another webinar in probably mid to late January to talk about the update and what the new tax law will be bringing us. I've got my quick disclaimer here that everyone's individual, family, or business tax situation is unique to them. Strategies may not apply in certain circumstances or business environments. And if you do have any questions, and we'll talk about this more at the end, but any questions or assistance that in implementing these or other year-end planning strategies, please give us a call here at 704-552-8689, or just email Kristen at newtonassociatescpa.com. Let's talk a little bit about general tax planning first. Selling any investments on which you have a gain or loss this year, I call that matching gains and losses. And something that I think is important to touch on, and that is that most of you have probably heard, maybe all of you have heard, that there's this thing called the wash sale rule, where you cannot buy back a stock within 30 days or a mutual fund within 30 days of selling it. That has to do only if you're generating a loss, not if you're generating a gain. Now the question is, why would I want to generate gains here towards the end of the year? Well, primarily, if you do have some losses through the year. I know we've had a very good year in the stock market, but it's still possible that folks have some losses that have been generated this year. So if you do, instead of taking that $3,000 a year loss and eating up your carryovers, you can go ahead and sell some stock that you have gains in. And if it's a stock, I'm just going to throw out an example. For example, Apple. Maybe you've got Apple. If you do, you certainly got a big gain in it now. And if you were to sell Apple today, there's nothing to keep you from buying it back tomorrow. That would not affect your gains that then offset other losses. Also, if you're using mutual funds, that can work even better. Even if it is a loss, if you want to harvest some loss against gains that you've had previously this year, you cannot buy back that mutual fund within 30 days, but you can buy back a similar fund the next day or even that day. So that is something that you can definitely do. If you're anticipating an increase in your taxable income this year, or you're expecting a bonus, consider the timing of it if possible. If you have any say-so over when you receive your bonus or even your last paycheck of the year, if you can defer that to next year, it's possible that you may have lower taxes next year as well due to the new tax law. And if nothing else, you can push them off from a timing standpoint. The third item that I want to speak to here is prepaying deductible expenses such as your charitable contributions, medical expenses this year using a credit card. And you'll notice very quickly that I've got Ed's caveat there, and I will talk about that in a second. Again, thinking about the new tax law, what it may be, certainly I believe that taking deductions in 2017 is going to be better than 2018. At this point, we're not really sure what will happen. It does look like the mortgage deduction will stay in for folks, and you'll probably be grandfathered, for folks that have mortgages currently existing of $1 million or less. However, if it's above $1 million, you'll certainly lose that. And also, so you could pay your mortgage premium this month, at the end of the month, and I'll talk about that in a second, but using the credit card to pay some charitable contributions that you were going to make in January anyway, some medical expenses that you were going to pay in January or February. My caveat is, what my caveat always is about credit cards. You only want to use credit card if, in fact, you can pay it off. I certainly do not advocate running up credit card debt in order to try to save on taxes. So please know that that is not what I would like for you to do. If your company, grants some stock options to you, you might want to exercise those options or sell the stock acquired this year if you think your tax bracket will be higher than next year. So if you know that you're going to have a significant increase in income next year, and again, you can pull things back into 2017, you may want to look at that. Self-employed, this is one that a self-employed person does have some pretty good flexibility. If you are self-employed, or if you own the company that you are, you're the owner of the company, whether you're considered self-employed or not, then what I would suggest that you can do is you can time the invoicing of your clients or your customers as well as the collections. The same thing is true with the expenses. If you have some expenses that are due in 2018, but you can accelerate and pay them this year, then that will work quite well. To give you a good example, I had someone in my office just this morning, and we were talking about his tax planning, and in fact, he does have the ability to time some of the invoices that go out to his clients, so he's going to push those off a little bit because we feel like that his taxes rate will be lower next year than it is this year. Accelerating some income and deductions into 17, that goes along with what I pretty much talked about that already, and that is if you can pull some deductions from 2018 and bring them back into 2017, that would be could be quite advantageous. One item, again, I believe that the mortgage interest deduction will remain. However, you can make your January payment on December the 30th or 29th, and then have the interest portion of that payment be deductible in 2017. It is a timing difference. I've had people ask me about that. It is definitely a timing difference. However, I would rather keep the money for a year than give it to Uncle Sam any day of the week. Excuse me. But you do need to make sure, if that's what you want to do, that the bank actually receives the payment in December, because when they do the Form 1098 that tells you how much your mortgage interest deduction is for the year, they look at it and they process it as of when they get the check. So you would want to make sure of that they get it this year. If you're close to that threshold, and we've talked about that on some earlier ones, for single filers, you're looking at $200,000 in adjusted gross income, and for married, for W-2 wages and business income, self-employment income. $200,000 for single, $250,000 for married, make you liable for the additional Medicare tax or net investment income tax. Again, if you can keep those, if you have some control over that, if you can keep those below those thresholds, that will also potentially save you some money. One of the items that you can do to accelerate deductions is pay your state estimated tax in December instead of January 2018. That's quite possible to do. Instead of making, for example, here in North Carolina, it's due on January the 15th. So if you make it on December 31st, you would be able to deduct those state income taxes in 2017 instead of waiting till 2018. And again, another reason to do that one in particular is it does appear that the state income tax deduction will be going away. It appears that they may keep the property tax deduction up to $10,000, but it does look pretty assured that the state income tax will be going away. So I would definitely suggest anyone that makes estimated payments to make that payment, the January payment, in December. Same thing with your property tax bill. If you escrow property taxes, again, it makes it a little bit tougher. But if you make that payment yourself, then I would suggest strongly that you go ahead and take your entire 2018 property tax bill that you would normally pay in 18, pay it in 17. It's also, and this one I think is it goes along with the state taxes, state income taxes, paying any 2018 tuition you have in 2017 to take the full advantage of that American Opportunity Tax Credit. That is, again, something that is going to have major overhaul, if not, in fact, go away. So I would certainly attempt to try to do that. And then touching again a little bit about those threshold expenses such as medical expenses and miscellaneous itemized deductions. This is going to hit my airline pilots and flight attendants and flight crew pretty hard. The miscellaneous itemized deductions looks almost assuredly as going away. So you want to certainly try to pull any of those back, any medical deductions, medical expenses you have, try to group those all in 2017. If you can make any miscellaneous itemized deductions, and that's employee business expenses and investment expenses, that sort of thing, if you can prepay those or pay them in 2017, I would definitely suggest you do that. The health care law, it looks like we're going to go another year without having anything done to Obamacare. Not a political statement, just a statement of fact. I think everyone realizes that something needs to be done with the health care law still, and they did not get it done this year. But I would suggest that if you haven't signed up for health insurance this year, if it's not through your employer, do so now to potentially avoid and minimize the penalty. Also, depending on your income, you may be able to claim the premium tax credit that reduces the premium payment or reduces the other tax obligations that you may have. The additional Medicare tax, that again applies to folks that have income exceeding $200,000 if you're single, or $250,000 if you're married filing a joint return, and subjects you to an additional Medicare tax of 0.9%. Again, not a big number, but the more you can put in your pocket, as far as I'm concerned, the better. So if you can keep that taxable, that W-2 income and your active trader business income below that $250,000 if you're married filing jointly, then you will save that 0.9%. High net worth individuals should certainly consider contributing to a Roth and a 401k. I get a lot of people say, well, I make too much money to put into a Roth. And that may be true for a married couple. The rate this year, the max is about $197,000. If you make more than that, you can't do a Roth. However, and you may have heard the term, there's what we call a backdoor Roth, and that is it's most helpful if you don't have any other traditional IRAs. You can still do it if you own a traditional IRA, but where we find it really works well is for our clients that do not have a traditional IRA. What you actually do with that, I'm digressing just a little bit, but I think it's a good point to make. And that is that you go ahead and make your contribution to your IRA, a traditional IRA, $5,500 if you're under age 50, $6,500 if you're above age 50 or above. Then you can immediately convert that to a Roth IRA. So even though you're putting it in the traditional IRA originally, you convert it, and then therefore going forward, all of the earnings are tax-free, grow tax-free. So that's something that we try to do for our clients as well. Again, if you're close to the threshold for the Medicare tax, it might make sense to switch your retirement contributions to a traditional IRA, thereby avoiding the 3.8% net investment income tax. That one certainly is a little more, I would say not as many people that would help, but it is something I think you should know about and at least be cognizant of. So that would be another one. Boy, here's the big one, alternative minimum tax. If you believe the House of Representatives, the AMT is going to go away. If you believe the Senate, then it's going to stay, but the numbers are going to get larger that it would apply to. And for those of you that have somewhat heard of alternative minimum tax and either are not subject to it currently or do not know if you're subject to it or not, I like to tell people it's not alternative and it's not a minimum tax. It's actually required if you're subject to it, and it causes you to pay more tax. So it's never a good thing to have alternative minimum tax. For this year, the exemption does go up just a little bit. You can see the numbers there. I won't go through those. Charitable contributions are another way that you can certainly accelerate into 2017. That's another one that does appear will be going away. Again, we don't know for sure, but I would not be surprised to see the charitable contributions go away. Property can be donated to a charity as well as money. I imagine most of you know that. Most all of us give to Goodwill, Salvation Army, some hand-me-downs or whatever. So you take in general, you take the deduction for the fair market value of those properties. However, you do need to have a good written record of those contributions as well. And then we have quite a few clients that towards the end of the year, they want to give additional funds to their church or another charitable organization, and they will contribute appreciated property, for example, stocks, typically is what we find, is that you can gift to, I'm just going to use the church as an example, give it to the church, the stock in kind. In other words, you would use your investment advisor to transfer the stock in kind to the church, into the church's account, and then the church can sell it or whatever. The two things that really would be beneficial to you are, number one, you avoid paying the capital gains on any profit, and second of all, you get the donation for that fair market value. Investment gains and losses, I touched on this a little bit earlier, the idea that it's going to be, I feel like going forward, we're really going to look more about managing the capital gains than we are minimizing taxes per se. So again, if you are below the threshold amounts that we talked about earlier in 2017, you might want to take those gains this year so that you do avoid that 3.9% net investment income tax that I mentioned a little bit earlier. Those that are above the threshold, especially if you think you may be below it next year, then you might want to go ahead and take the losses for that this year. Continuing on with that, the idea of minimizing taxes on investments by judicious matching of the capital gains. That, again, I spoke to that a bit briefly, a bit ago, briefly. And there you really want to look this time of the year, and I've got a lot of financial advisors that have contacted me recently about their clients, and certainly we've talked to our clients about this as well. And that is, if you have in a what I call a taxable account, so it's a non-qualified account, so that you have to pay taxes on whatever gains that you have during the year, you can work it or potentially work it to where it will allow you to harvest those gains without an abnormal large amount of taxes being due. So again, that would be something to get with us if we're your CPA or your own accountant, and talk to them about if that would be something that would be available for you. This is always the case, but it's just something I do like to bring up towards the end of the year, and that is you want to try to avoid short-term capital gains if at all possible, and that's a gain that you've had in a stock or mutual fund, ETF, whatever, that you've held for less than 12 months. That's because those gains are taxed at your ordinary rate, which could be as high as 39.6%, plus the net investment tax of 3.9%. So it can get up there and really wind up, by the time you throw state taxes in there, it could easily be nearly 50% of your gain would be taxed, whereas on the long-term gain, we look at a much lower rate. And again, just mention it one more time, reduce all your capital gains and generate your short-term capital losses up to the $3,000. So if you do have losses, you can only take, once you offset all of your gains against your losses, if you still have some losses, you can take up to $3,000 a year, and that $3,000, whatever you might have, that does carry over to future years as well. Looking at the wash sale rule that I mentioned a little bit earlier, if you do sell a security and generate a capital loss, you can repurchase it after 30 days. If you buy it back within 30 days, the loss is disallowed. And then this last point I think is really important, is that you can repurchase immediately another investment that's very similar. So that again would be in the case of an ETF or another mutual fund that have the same objectives as the one that you sold. So that is something that I think can be very good as well. And then I do want to point out one more time that that does not apply to gains. It's only losses. So if you need to generate some gains because of prior losses, you can actually generate those gains and then turn around and buy the investment right back. Talking a little bit about that net investment income tax now. That did go into effect in 2013. It's a 3.8% tax that's applied on investment income such as the long-term capital gains that we've talked about, if you hit those thresholds that I mentioned several times before. The short-term capital gains, and I just alluded to that a minute ago, you still are subject to ordinary income taxes as well as the 3.8% of the net investment income. So that on short-term capital gains, you can really eat up your gains very, very quickly. Looking at mutual fund investments, it is nice to find out if the dividend is paid at the end of the year or whether it's going to be paid early in the next year, but deemed to be paid this year. And most of the mutual funds will pay out dividends at the end of the year. That also comes up into play, I should say, if you're in a non-qualified or a taxable account. In those types of account, it's probably not a good idea to invest in a fund that is going to have a large capital gain distribution or even a dividend distribution right at the end of the year, because even though you may have only held the mutual fund for a short time, you could be responsible or would be responsible for paying the tax on that capital gains or dividend that they distribute. So that could definitely make a substantial difference in the tax that you pay. And again, the last note there, the mutual fund distributions generally will qualify for the same tax relief as the long-term capital gains. And by that, I mean the lower tax rate, the 15% or 20%, depending on your other taxes. Year-end giving to reduce your potential estate tax. Not a lot of people are subject to estate tax any longer. As you can see here, that for the year 2017, it would only come into play for folks that have more than $5.49 million. And married folks, you actually double that, so you're really pushing right at $11 million. So again, I think that I read recently that it's something like less than 2% of estates have to even be considered about estate tax at all. However, that is something, again, in the new tax law that we don't know what's going to happen yet. The House wants to get rid of it completely. The Senate says, well, we don't want to get rid of it, but we want to give it even a larger exemption. So we'll just have to see how that pans out. That ATRA, that was the Tax Reduction Act from last year, I believe it was, maybe 2 years ago, that set the maximum estate tax rate at 40%. So once you go over that $5.49 million, you're immediately taxed at 40%. So this, again here, the sound estate planning begins with lifetime gifts to family members. I would just touch on that very briefly, and that is that if gifts can help reduce the donor's assets that are subject to the future estate tax, or another way to really look at it, I think, is just, if you're going to give some money to your heirs, and you can do it now's a good time to do it. You really don't have to wait until you die, if you will. You can give it now, and it gets out of your estate, and also you most likely would not have to pay gift tax on that amount. I've got a client that has done quite well in his life, and he wants to take, give his daughters an opportunity to potentially buy real estate or buy a house or whatever. So he has put in trust for them a substantial amount of money. We will be doing a gift tax for him, but even though, and quite honestly, it's $1 million to each daughter, he will be able to give that $1 million with absolutely no tax consequences to him and no tax consequences to the daughters either. So the daughters do not have to pay income tax on gifts. I get that question quite often. Some will say, well, my mom's looking at giving me $100,000. How much income taxes will I have to pay? If it's a gift, you don't have to pay any income taxes at all. And depending on your mother's circumstances, most likely, she would also not have to pay any gift tax. This year, without even filing a gift tax return, you can give $14,000 to any donee you'd like during this year. Next year, it goes up to $15,000. That exemption does not carry over, though. So you must make your gift by December 31st if you want to use the $14,000 exclusion for this year. A couple more gift tax tips, if you will. Cash or publicly traded securities raise the fewest problems, as we talked about. You may choose to give that property to increase the value so that you're giving more value to the donee. You also shift future appreciation to your heirs that keeps it out of your estate. So that would be another good reason to make gifts this year. For example, if you were to give an heir 100 shares of Apple stock, then any future appreciation that happens with that stock would not be in your estate. It would go for them, and if and when they sold it, then they would pay the taxes on that gain that's been triggered. The idea of triggering IRS questions about the gift's true value, that can definitely come into play, especially if it is something other than a publicly traded stock. If you wanted to give some privately held company, some stock that you have in a privately held company in your own company, then I would suggest that you definitely need to get with an attorney as well as with a qualified tax advisor that can help you through this area. Retirement plan contributions. Maximize your retirement contributions to the extent you possibly can. If you do own a business and have not set up a retirement plan, you really should consider setting one up now. It doesn't have to be funded until 2018, and different plans have different rules as to when it has to be done, but generally it has to be done by April 15th. So you can, for an IRA, for example, you can fund an IRA on April 15th and have it deductible on your 2017 return. The same thing with your 401k, contributing the maximum amount, which is $18,000 for 2017. And again, if you are 50 or over, you can put another $6,000 in, so for a total of $24,000. This slide talks about the $5,500 IRA that we just spoke about that you can put in, and again, the deduction is allowed in 2017 if you qualify for the deduction, but yet you may not pay it until the early part of 18. And the IRA also has a $1,000 catch-up if you're age 50 or older. Health savings accounts, again, you can deduct the contributions to the account. The investment earnings are tax deferred until withdrawn, and the amounts that you withdraw are tax-free, notice, when used to pay medical bills. It must be for a qualified medical expense for the HSA to be deductible. The HSA, if you're age 65 or older, it does function much like an IRA. And to be able to have an HSA, or health savings account, you must have the high deductible health plan. And only that insurance is subject to numerous exceptions. And you must not be enrolled in Medicare. So if you're in Medicare, which most 65-year-old people would be, then you cannot have an HSA. The minimum amount deductible, your minimum deductible in your high deductible health plan for 2017 must be at least $1,300 for single coverage or $2,600 for a family in order to be able to contribute to an HSA. Again, I'll just give my disclaimer one more time. Everyone's individual family or business tax situation is unique. These strategies may not apply to you in certain circumstances or business environments. And if you do have any questions with implementing any of these or any other tax year-end planning strategies to make sure they're suitable for you, please call our office. You may call 704-552-8689, ask for Kristen, or email her at kristen@newtonassociatescpa.com. And with that, Jeff, I believe I'm finished.
Great, Ed. And for everybody on the call live and on the replay, we want to thank you for being here with us today. For those of you, again, that have questions for your specific circumstances, we want to invite you to call Kristen Hensley in the office at 704-552-8689 and go ahead and schedule a time where Ed will be happy to have a short call with you to address anything that we may have covered here. While Ed did not cover the anticipated new tax law, again, as he mentioned, we'll be back shortly after it's enacted to brief you on the consequences it may have. So again, thanks everybody for being on the call, and we'll talk to you soon. Thanks, Ed.
Thank you, everyone. Bye-bye.